Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, December 18th. Hope you guys are having a wonderful day so far. Wow, we're getting really close to Christmas here. We got a couple economic news to go over today. We'll start off with the housing starts for the month of November. So in October, we had 1.217, annualized units for the year. And the forecast is supposed to increase to 1.23 and it exceeded that to 1.256. So great headline number here. I'll touch on this in a bit here after I finish permits. So we got the future housing starts here with building permits, and that's why this is an important number here. So in October we had 1.265 annualized permits, annualized units for permits, and it exceeded that to 1.328. So both great numbers here. The drawback, the reason why I want to touch on this is the drawback on these increases aren't in single families. These are all multi-unit properties. So the drawback is it's not helping the housing market, it's helping the rental market, unfortunately. So that's the negative about these numbers. These numbers look great on the headlines, but unfortunately, the underlying numbers, when you look at them, all these increases are in the multifamily units, not in single families here. And unfortunately, that does not help our housing market. So let's kind of go forward here to the headline. Stock market is up after a big sell-off yesterday. Stock market is kind of cash or kind of buying in low on there. So I do think it's kind of more of a head fake because you're going to see a lot more coming up here. And then we got FMC kicking in their two-day meeting today. Especially, it's widely expected that they're going to raise their rate a 0.25% tomorrow. So we should get that news. The big thing tomorrow is investors going to be looking right towards the dot plot, which is the map of future rate hikes for 2019. They want to see if the Fed is planning to raise any more rates tomorrow. And they may put it on there just for the possibility, but that could disappoint Wall Street because right now they're even criticizing and urging them not to even raise rates tomorrow, as right now we're in more of a neutral level, and by raising the rates again tomorrow, that will put us into a negative yield curve position. This is all kind of part of the concerns that the investors have out there. First off, we have a slowdown in the global economy here, and you have China that came out with some not so good news, a slowdown in their Europe is coming out with some slowdown. U.S. economy is still doing pretty well, but at some point it's going to reach the U.S. here, a slowdown, and they're not liking, they want to see continued growth, not a slowdown. And and what the Fed does when they raise these interest rates is slow things down so it doesn't get out of control. And and right now they've been criticized for being a little too aggressive in their rate hikes as we speak. But there has been some mention of late, like the last maybe month or so, by some Fed members that they've been kind of insinuating that maybe they might be at towards the end of their rate hike cycle here, that they may be at that neutral policy where if they do nothing, it's not going to deter the economy. It's not going to pull it down or pull it or push the economy further. So it's kind of be that neutral policy is where they're trying to reach, and some members have kind of insinuated that maybe we're there. Also on their agenda, the concerns have, of course, been on the trade front, and of course, Chinese President Xi Jinping made had a not meeting, but a speech today to the people in China, and basically had a pretty strong message out there. Basically, so we don't know if this is more of a message for the people or if he's kind of a message to the U.S. saying that they're not going to be walked over type of thing. So. I don't know if anyone really expected us to think we're going to walk all over them, but but it's hard to say. Hopefully, things can get worked out through both parties. They seem to be willing, and of course, we're willing to work together on a program that hopefully benefits both countries, not just one-sided. So. Let's kind of see how this is affecting the bond market. The bond market is doing quite well today. As you see, we started the day up higher. We did come down a little bit, which helps us create a little bit more of a foundation here. We're going up against this tough ceiling of resistance here, the 200-day moving average here, and currently we're up about 16 basis points, which will bring us to a better pricing today. Even yesterday, we improved quite a bit, so a lot of lenders did not price in that positive pricing yesterday, so they'll probably get yesterday's as well as today's improvement in pricing So that would be a good sign here. So you should see a lot better pricing on your rate sheet today for those who are looking to refinance or purchase today. Again, we'll have to kind of wait and see if we can break above this. If we break above it, we got a nice little room here to continue growing here, and this will become our floor of support versus a ceiling. Same thing at the yields. As you see, the yields already broke through a very tough floor of support, and right now is already touching on the next level of support, these two Fibonacci levels here, and we'll see if that holds. This is currently at about 2.83 where we're at in the treasuries. So good day today for mortgage-backed securities and interest rates, so we got a little bit of improvement. But we'll pretty much call it a day. If anything else changes, I'll post on Twitter. You can find me at Mike Bjork on Twitter, so you can always see any changes that happen to the market over on, as I just kind of post on Twitter. It's much easier that way for me to communicate those changes out to people. You guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.